Welcome to the Sharkpreneur podcast with Kevin Harrington and Seth Greene. Kevin Harrington is the inventor of the infomercial, one of the original sharks from the hit TV show Shark Tank, and has generated over $5 billion in TV and digital direct response sales. Seth Greene is the world's first trusted authority on cutting-edge direct response marketing, a best-selling author, and the only 3-time Marketer of the Year nominee. On the podcast, Kevin and Seth interview Sharkpreneurs who share straight talk on what it takes to explode your business.
Why do so many businesses struggle while others seem to explode overnight? Do you wish you had the secret to this type of exponential growth? Now, I've scaled more than 20 businesses to over $100 million, and it's not just luck. In my new book with Mark Tim, Mentor to Millions, you'll learn the repeatable framework I use in all my business ventures for massive success. Order at kevinmentor.com and get over $1,000 in bonuses. Head to kevinmentor.com.
This is Seth Greene. Welcome to the podcast. Today I have the good fortune of interviewing Craig Novorr from Paragon Capital. Craig, thanks so much for joining us.
Oh, thank you for having me.
All right, let's go back in time a little bit. Before Paragon, you were at UMB, correct?
Absolutely.
All right, tell us a little bit about your experience co-managing the UMB Scout Technology Fund and the Scout Growth Fund.
Absolutely. So I started at UMB in the Trust and Wealth Management Department right out of college. I started out as a trader, trading stocks and bonds and kind of learning how the market worked. That was back in the mid-90s. Made my way out to be a portfolio manager, and the bank decided they wanted to start a technology fund. So they asked me if I could start that process. I hired my co-manager, kind of helped set up the parameters of the fund. We got everything registered with the SEC. And the start date the SEC gave us was May 1st of 2000. And so the stock market crashed in March of 2000. And so by the time we got our green light to start trading, everything was already down 10 or 15%. We were excited because we thought we were getting good prices and a good bargain, only to watch it, the NASDAQ drop 80% that year. And it was a great learning experience. Our fund stayed in the top quartile. Our performance was pretty good considering our mandate was to stay 100% invested in technology at all times.
Wow, so that was one heck of a, and then of course you walked into 9/11, and then 9/11 occurred shortly thereafter. So how long did you run that fund for, and what prompted you to switch to Paragon?
Absolutely. So I ran that fund until 2005. The bank decided to shut it down and switch over to just a growth fund. So I helped co-manage and start up the growth fund in 2005. At that time, I was managing a large book of high net worth individual clients. I had some very large institutional pension plans, and then I was managing the mutual funds as well. Decided I hit my 10-year anniversary in 2006. Reconnected with my mentor who had hired me at UMB. He left in 1998 to start Paragon. Reconnected with him, and we worked out a deal for me to be his succession plan. And I moved over a couple weeks after that on August 1st of 2006 and started working towards a transition plan that we completed in 2009 for me to become president and majority owner.
All right, well, congratulations. You've had a heck of a journey. I know the longer version is probably going to be in a book. So let's talk a little bit, because you've established now some unique areas of expertise at Paragon. Tell us a little bit about what you're doing. It's a little bit different than the plain vanilla, stocks, bonds, and other investment products that you grew up with.
Absolutely. So being a fund manager, we started out the company mostly doing individual stocks, individual bond portfolios, which is unique in and of itself these days because a lot of people are using ETFs and mutual funds. But after watching the stock market crash 50% in 2000 and 53% in 2008 with the financial crisis, started thinking to myself, there's got to be a better way to protect clients from these big, huge swings that nobody likes to go through. And so we looked at every option out there, from doing an option strategy to help protect the clients. But in that case, if the market goes up, you underperform from the price of the options. And the market goes up 2/3 of the time. It only goes down 1/3 of the time. So the option strategy really isn't a winning strategy long term. So we came up with the idea of using structured products as a way to put protection underneath our clients while still being able to outperform the market on the upside, depending on how we structure the terms. Looking into it, there was a lot of negative articles online, dozens and dozens of pages of our negative articles about structured products. Most of it had to do with outrageous fees, front loads, capped upsides, just really bad terms for the client. And what we were able to do using our connections and our experiences from back in our previous jobs was to create our own structured products where we would create the terms for our clients. We go out to a dozen or more independent large banks like Goldman Sachs, Credit Suisse, Barclays, Morgan Stanley, Societe Generale, Citigroup, and we have them compete to create these notes for us. So we contact them in the morning. We tell them what we're trying to create. We give them 2 of the 3 variables, and then they bid on that 3rd variable back to us. And by doing that, we can create terms that so far nobody else in the industry's been able to match us on. And
that is absolutely fascinating. So I love the fact that you've created a different way to play the game. For example, I'm sure you've seen the movie and read the book about the guys who started out, who actually figured out that the subprime crisis was coming and was trying to go bank to bank to find someone to take the other side of that bet because there was no easily tradable vehicle to short subprime mortgage bonds. However, so then hypothetically, could you perhaps create a structured note that would short student loan debt?
Yeah, so we're not shorting anything right now. We're going mostly long. So what we're doing is, for example, we could do the S&P 500, the Dow Jones, and the Russell 2000, or we could do the S&P and Euro Stoxx 50. We want things that are fairly correlated with each other, because a lot of these notes take the worst performing of the indexes that we go against. You could do a basket of individual stocks. You could do a basket of indices. You could do a basket of currencies, any which way you want, anything that there could be options written against. So what these investments actually are senior unsecured debt of that bank, in which that instrument is a 0 coupon bond with some options wrapped around it. And so, for example, the type of notes we've done recently on the equity replacement side would have a 20% downside buffer, which means that at maturity, which could be 5 or 6 years from now, if the market is down between 0 and 20%, our clients get all their money back. If the market's down more than 20%, like 25%, you would only be down 5%. So you'd only be down the difference between the market return and that buffer that we create. And then on the upside, we're having the banks compete for that percentage. So a recent one we've done would be 150% upside in the market. And so at maturity, if the market's up 50%, our clients would be up 80%. If the market's up 100%, they'd be up 150%. And that's uncapped, which means that no matter how high the market goes, they go up as well. The downside of the investment would be that you don't get the dividends every year that would normally be paid, but you're getting that oversized return on the upside. And so the total return at the end is very, very good. What we really like about them is, in a taxable account, these mature at long-term capital gain, not ordinary income. So they're extremely tax efficient for our clients as well.
So it's almost like you've built your own fixed indexed annuity in a bond where you pick the index, you pick how much downside you're willing to put up with and how much upside you're willing to trade away in order to avoid the downside. And you've got basically your own custom version of that, which is fascinating. So how has that been received in the marketplace? How have you done offering that to your clients and other investors?
Absolutely. So the neat thing about these is that they have a CUSIP, they're priced daily. While they're not necessarily liquid, we can get a client out of them at any point. So that's the difference between this and an annuity, is just the transparency of the investment, being able to see the pricing every day on their statement. As far as where the industry has come, we started doing this in 2015, and almost nobody we talked to had ever heard of it before, because it had been mostly an institutional product that wasn't readily available, or it was a product that was being sold from wirehouse brokers that had such bad terms that nobody wanted to do them. Now you're actually seeing this become very mainstream. You're seeing the new sexy term for it is defined outcome funds. So you're seeing a lot of ETF producers coming out with defined outcome ETFs. The problem is that those ETFs are a series of 1-year funds that roll over every year into a
Almost like
longer
a
term
UIT.
ETF. So the terms aren't as good as we can get when we're going out 5 or 6 years on that product. And that's kind of the main thing that we've been doing the last 5 years with that is that long-term growth. What's been a huge driver for us for growth this year is obviously interest rates have fallen to almost zero as a Fed funds rate target near zero interest rate environment, and the 10-year treasury at 0.8. A lot of clients and a lot of people are really hurting to find a way to generate income in their portfolios. Earlier in the year and in past years, they were searching for income using risk. Maybe they were buying master limited partnerships that were paying double-digit income, and then those dropped 70% in April when the oil market crashed. Maybe they were buying high yield debt. Well, today high yield bonds are only yielding 3 or 4%, so you're not getting paid for the risk that you're taking in that credit. Maybe they were looking at preferred stock or different things that they were searching for income. We were able to offer what's called a callable yield note, which is a variation of the structured product where it's a 12-month, 18-month, short-term type of note. And we did 2 of these yesterday, actually. We did one that was an 18-month term, and it's got a 70% barrier. And a barrier is a little different than the buffer we did before, in which this protects the first 30% downside in the market. And we take it out to bid by the banks, and we did a worst of the S&P, the Dow, and the Russell. And we got 9.52% interest rate paid quarterly. And so as long as those indices are between negative or 0 and negative 30% every 90 days, the client gets their quarterly payment. If one of those markets drops more than 30%, then they would not get their quarterly payment that quarter, and we'd move on. At maturity, as long as the market's not down more than 30%, they get all their principal back. If the markets are positive, the bank can call it. So right now with the markets at an all-time high, we're getting a lot of these called, and then we're reinvesting them in another note. And so they invested X amount of money, they got that money back plus their coupon payment. But in an environment where you're getting 1% or 2% on bonds, and we're able to pick up 9.52% with just a moderate amount of risk, and our market outlook right now with the vaccines coming and a lot of positive things in the market, we don't see a 30% correction in the next 18 months. So we think the risk is minimal for the return that you're getting on that type of investment.
That is absolutely fascinating. So and again, we're not making an investment offering on this show. Do your own due diligence and contact Paragon Capital. I'm wondering, what are the investment minimums for something like this? And do you have to be an accredited investor to get in them? How does that work?
Yeah, so you do not have to be an accredited investor or a qualified investor for structured notes because they're actually just a corporate bond. And so it's not an alternative investment from that perspective. Paragon Capital Management, we have a $500,000 minimum investment to be a client. But once you're in that door, so a lot of our clients that provide $500,000 for the investment, we'll maybe buy them $10,000, $50,000 notes so that we can diversify those observation dates, diversify the maturity dates, diversify the banks that we are buying them from so that they'll have multiple banks, multiple maturity dates, multiple terms to help diversify the credit risk, the interest rate risk, and a lot of the different things that we can help mitigate by diversification.
Okay, so does that entire $500,000 have to go into structured notes, or could you hypothetically put 90% in traditional investments and put the other 50,000 in structured notes?
Absolutely, and we have a lot of clients who do that. So we've got what we do is we sit down with our clients. We have a full-time financial planner that's been an estate planning attorney for over 30 years. We've got a great team of investment experts. We have offices our headquarters are in Kansas City. We have offices in Dallas and Austin, Texas. We work with clients from coast to coast, but we sit down with them first, either virtually or in person, and we figure out what are they trying to accomplish with their investments? What are their goals? what are their risk tolerances, what are their income needs. And then from there, we can help design a portfolio that could include either traditional investment classes like stocks and bonds. It can be supplemented with structured notes or callable yield notes. We're working with some clients right now on private investments, private equity, private real estate. And so we work with a lot of the major partners like Blackstone, BlackRock, JP Morgan, Goldman Sachs, Alex Brown, different firms that can help us provide some excellent private investments for our clients that are looking for that asset class as well.
All right. And then you've also received some accolades as well. You were named Kansas City Magazine's best personal wealth manager for 6 consecutive years. Tell us a little bit about that.
Yeah, absolutely. So real proud of that. You know, that's something that the clients nominate for, and it's sponsored by one of the local magazines here in Kansas City. And actually they've been doing that for the last 14 years. I've been nominated 13 out of the last 14 years. They changed the program for some compliance purposes. So I've gotten 6 years in a row under the current program, but 13 out of 14 in the 2 programs combined. And so to me, it just shows a level of consistency and what we're trying to do for our clients, which is putting their needs first. And everything we do is, try to make a great client experience for them. And in return, they are obviously nominating me and giving me the accolades, but it's a team award. It's Paragon, it's everybody behind me. It's our operations staff, it's our traders, it's everybody that makes that experience great.
All right. Well, congratulations on the success and the innovation. For our listeners or viewers who are interested in learning more about you and how Paragon's unique approach can help them, where is the best place for them to go to learn more?
Absolutely. Our website is www.paragoncap.com. You can reach me on my email, which is cnovorr, Novorr at paragoncap.com. Our office phone number is 913-451-2254.
All right. Well, we greatly appreciate your time. Fascinating interview. And let us know when the book comes out. We'll be happy to discuss that then. This has been Seth Greene here interviewing Craig Novorr from Paragon Cap. Craig, thanks so much.
Absolutely. Thanks for having me.
Do you need money to fund your idea, product, or service? Are you ready to take your business to the next level, but need capital to get it done? Kevin Harrington has heard more than 50,000 pitches and knows how to help you make the perfect pitch to get the funding for your entrepreneurial dream. He's distilled the process down in his perfect pitch cheat sheet, and it's yours for free. Just text PITCH to him right now at 727-888-2100. Text PITCH to 727-888-2100 right now and claim your free perfect pitch cheat sheet. Text PITCH to 727-888-2100 to start funding your dream today.
This show has been produced by Market Domination, LLC. To discover how you can have your own show completely done for you and turn it into a real published book and become the authority in your marketplace, go to www.marketdominationllc.com/podcast offer.